Hey everyone, welcome back to Kitco News. I'm Jeremy Szafron. A great repricing appears to be underway across global markets, and we're seeing it in real time. Gold is smashing fresh records, trading near $3,700 an ounce as investors price in lower real rates and a weaker dollar. And silver, look at that chart. It's at its highest level since 2011, above $42, and that's a 14-year high, by the way. Now, the dollar is on the back foot into this week's Fed decision, nearing multi-week lows against major peers. And I got to say, do you remember 17 years ago today, September 16th, 2008, the FOMC held rates steady at 2% while the Federal Reserve's primary fund broke the buck. And that night, the Fed authorized up to $85 billion to rescue insurer AIG. Now, the New York Fed president missed the meeting because he had to deal with AIG, and history doesn't maybe repeat, but does it rhyme? The Fed's meeting today is under intense political pressure, and market is betting on a rate cut almost 100%, according to the CME FedWatch tool. And our guest today has long called that a catastrophic mistake. Joining me now is Euro-Pacific's Peter Schiff. Peter, welcome back. Good to see you. Thanks for joining us.
Oh, thanks for having me on. I guess I forgot to dress up. I forgot that you're so professional at Kitco.
Thanks, mate. Well, we try to be, and we try to get to the actual news. And, with that, I got to ask you, is the market finally being forced to price in the decades of policy errors that you've warned about here?
Yeah, in fact, we're about to make another one. This may be the biggest error yet for the Fed. They're going to cut rates tomorrow. And not only should they not be cutting rates, they should be raising rates. I've said all along that they waited too long to raise rates, which a lot of people now agree with. And of course, they never should have cut them the way they did. That was an even bigger mistake. But they aborted the tightening too soon. And I think the reason they did it was because the banks started to fail. That was really the catalyst. It wasn't because they won the battle over inflation. They were just afraid to keep waging the war because of the collateral damage. And I think that's the reason they're about to cut in the face of worsening inflation data. Not only is the official rate well north of their 2% target, and inflation is further above 2% now than it ever was below it. And when it was below target, we had 0% interest rates, we had quantitative easing. It was this huge emergency that 1.5% inflation is just too low. We have a 2% target, so they had to do whatever it took to rid us of the menace of 1.5%, right? We had to have 2, but 3.5. No, that's fine. We can cut rates. We don't need to fight 3.5% inflation with the same ferocity that we fought 1.5% inflation from the other direction. But the reason that the Fed is ignoring not only inflation above target but rising is because of the cracks in the foundation of the economy, and the Fed has been able to kind of deny that based on bogus jobs numbers. Well, now that we've had a lot of revisions, the Fed can't pretend that the labor market is as strong as they've been pretending, and so now they're going to cut rates because of the weakness in the labor market and the economy. But the rate cuts are not going to deliver the expected relief. I believe that they will backfire in that they will cause long-term rates to rise, which is really what they want to reduce. And that will ultimately usher in a return to quantitative easing. And that's the nail in the dollar's coffin. And I think that's why you're seeing, the dollar is weakening today. I think right now it's the second lowest level of the year. If you look at the dollar index, now we have a back at a 96 handle. And yeah, gold almost crossed $3,700 an ounce this morning. It'll probably, cross it either later today or by tomorrow. I think that, the central banks are voting with their feet when it comes to their preference to own gold. They're getting rid of their dollars. They're getting rid of their treasuries, and lower interest rates are just going to accelerate that move.
Yeah, well said. And we can start with that dollar reserve status kind of topic. The Treasury's TIC data shows China's treasury is holding near the lowest since 2009, I think about $756 billion as of June. Japan's still the largest holder, roughly $1.15 trillion. But, Peter, is the world actively repricing the value of holding U.S. debt?
Yeah, absolutely. Plus, you can't just look at the raw numbers.
Yeah.
Because look at all the additional debt that, we have, issued over the years. So if China still has the same dollar amount of treasuries it had 5 years ago, in relationship to the outstanding treasury supply, it's really going down.
Mhm.
And so that is the problem because our deficits have never been larger than they are right now. We took the problem that Trump inherited, and I say inherited because Trump was obviously president before. So he, is partially to blame for the Biden deficits. But he took those deficits and he made them worse with the big, beautiful bill. So the United States has to borrow more money than ever before. Plus, we have the problem of having to refinance almost $38 trillion. The national debt is financed with short-term paper. So the majority of the national debt will come due during Trump's term. So not only does the U.S. have to finance $3 trillion, $4 trillion of annual deficit spending, but we have to find buyers for, 10 trillion a year of maturing debt or something like that.
Yeah.
So it's enormous what we have to finance. And the world just does not want to do it. And they're diversifying out of dollars. And of course, we keep flooding the world with dollars because even though we have these tariffs, we still have $1 trillion a year trade deficits. And so what is the world going to do with all these dollars that it earns selling us all this stuff? Well, they used to buy treasuries. They used to buy U.S. stocks. Now they're buying their own stocks, and they're not buying treasuries. They're not buying dollar debt, and the central banks aren't buying it either.
Yeah,
The central banks are buying gold.
Yeah, and they continue to. I mean, we're seeing some of this data. Poland just came out with more figures. I got to ask you, I mean, with the foreign buyers like China and Japan stepping away from our treasury market, the U.S. obviously has that massive funding gap. And just yesterday, the Senate confirmed Stephen Murin to the Fed board official who's been publicly highlighting the Fed's forgotten, as he calls it, the third mandate, right, to pursue moderate long-term interest rates. Is this the administration's new plan to use the third mandate as a political cover to kind of force the Fed into permanent QE?
Well, there shouldn't even be a second mandate, let alone a third. The only mandate and should be no inflation or price stability, which should be defined as zero inflation. Although I don't think 0% inflation is necessarily better than falling prices. I'd rather see the cost of living go down than stay the same. But at a minimum, they should target stability, not 2% inflation every year. That's a 2% decline in your standard of living if everything is 2% more expensive. But the Fed can't really target interest rates by monetizing debt. Because in order to do that, it creates inflation, which ultimately puts upward pressure on the very long-term interest rates they're trying to suppress. So really, the best way that the Fed could try to create an environment where we have a sound economy with low unemployment and low interest rates is to have sound money, is to fight inflation. But that's the one thing that Trump administration doesn't want the Fed to do. The last thing that Trump wants the Fed to do is fight inflation. Trump wants the Fed to blow air into the bubble so he can take credit for a phony economic boom. And what he doesn't want to have to accept responsibility for is a bust, even if the bust is cathartic in that, we fix the problems that underlie the economy and we lay a foundation for lasting economic growth in the future. Trump doesn't care about economic growth in the future because he won't be president in the future. He's president right now. And so he wants to take credit for an economic boom. And the only way we can have one is to have a phony one. All we can have is a bigger bubble. And so that's what Trump's fiscal policy is trying to achieve. And that's what he wants the Fed to cooperate. He wants a massive bubble that he can put a big T on. And everybody can think they're getting rich as, they're going broke.
Yeah. So I mean, essentially printing money to finance the national debt at artificially lower rates. And I mean, we've seen a version of this in Japan for the last 2 decades. The result wasn't immediate hyperinflation, but economic stagnation and a collapse in their currency's value. I mean, the U.S. dollar is the world's reserve currency. If the Fed is seen to be openly monetizing the debt, doesn't that trigger an immediate or more of an acute global crisis of confidence far faster than what you've been predicting?
Yeah, well, I think it's already started. It's just
Yeah.
going to accelerate. And I think there's a real danger right now that the Supreme Court in this Lisa Cook firing, they may actually rule that Trump does have the right to fire her because they may rule that an independent Fed is not constitutional. They may say that the Fed needs to be beholden to an elected official, that there's nothing in the Constitution that authorizes a fourth branch of government. You
Mhm.
know, a lot of people say that, well, the Fed is the most powerful, Fed chair is the most powerful person, in the country. Well, but there's nothing in the Constitution that gives the Fed governor any power because there's nothing in the Constitution that even authorizes a Fed. So I think it's possible that they come out and say, look, the FOMC members have to serve at the pleasure of the president. There needs to be accountability to an elected official. They can't sit there above the law, or they can't be a government unto themselves
Mhm.
that's not authorized by the Constitution. And so it could completely destroy Fed independence, because what they're going to say is that the president can fire anybody from the FOMC for whatever reason he wants,
Yeah.
as long as he has a cause. It could be because, right?
Mhm.
I don't like that person, so get rid of him. And I think that will destroy what little confidence there is left in Fed independence. I mean, I've never really believed that the Fed was truly independent. I thought it was more of a pretense, but
Right.
everybody kind of like accepted it, even though it was pretty clear that Treasury and the Fed worked together, especially in times of a crisis.
Mhm.
They were always kind of working at dual purposes instead of providing the checks and balances. I mean, the Fed should be independent. The Fed is supposed to take the punch bowl away, before the party really gets going, not spike it and
Yeah.
make sure that everybody stays at the party too long. But I think if we drop the pretense of independence and let the world know that whoever we elect president is really the de facto chairman of the Fed, and as bad a president as I think Trump has been with economically, he could be succeeded by somebody far worse.
Yeah.
I think, like, if AOC was president, I think she would even do more damage with the Fed than Trump will do. Um,
You
so,
scared
but
you
personally,
scared our viewers there, Peter. You scared bringing up AOC. I got to ask. I mean, because for years critics have argued that the Fed is, unelected, unaccountable body with far too much power. Isn't this political clash, as messy as it is, a necessary and maybe even a healthy process? Do you think it's time for the Fed's power to be challenged and for it to be brought under some form of democratic control, even if it's chaotic?
well, I mean, first of all, nobody has been a bigger Fed critic over
Yeah.
the years than me.
Yeah.
I mean, I blamed them before the 2008 financial crisis, before it happened, because I knew the crisis was going to happen, because I understood the monetary policy mistakes that the Fed was making. But be that as it may, the only thing worse than the Fed we got would be a Fed controlled by the president.
Yeah.
I think to the extent that there's any independence at all at the Fed, that's better than no independence. Now, ideally, right, if it was up to me, there would be no Fed. But that doesn't mean that I would just hand the printing press to Congress or the president. I think we should have the same monetary system that existed before the Fed.
Interesting.
And before we had a Federal Reserve, the only thing the U.S. government did was coin gold and silver, which is all that's authorized in the Constitution. And to the extent that we had banknotes that circulated, they were all issued by private banks. They were not issued by a central bank, and they were never issued by the United States government. Now, in theory, if we can go back to the original intent of the Federal Reserve in 1913, that's still not that bad. The problem was the camel's nose under the tent. The original Federal Reserve was a private banking syndicate. That's why it's independent, because it was never part of the federal government,
Mhm.
because the federal government is not allowed to do what the Fed does. The federal government doesn't have the constitutional authority to print money. Only private banks can issue paper currency. There's no monetary authority in the Constitution for the United States government to do that. So they allowed the Fed to do it. But I never liked the whole relationship between the government and the Federal Reserve. But at least the way the Federal Reserve was originally conceived, in the original Federal Reserve Act, it was illegal for the Federal Reserve to own any U.S. government debt. It couldn't buy it and it couldn't own it. And they changed that. And it still can't buy it. The Federal Reserve is not allowed to buy any treasuries directly from the U.S. government. That's still the case. But it is allowed to buy them in the secondary market. And that's what it does through these primary dealers. But the way the original act was conceived and ratified, they weren't allowed to own them at all. And that's because the Congress that passed the Fed did not want the Fed to facilitate deficit spending. They didn't want the U.S. government to be able to rely on the Federal Reserve to finance debt. And that was very smart. Now, if they were even smarter, they never would have established the Fed, because they would have realized that once that power was there, it would get abused. And it didn't even take long. They amended the Federal Reserve Act shortly after they passed it so that the government could use the Federal Reserve to finance World War I. And so, it didn't take long to corrupt it. But my criticism of the Fed is not because of its independence. I criticize the entirety of the institution. But I recognize that if we gave the power of the printing press directly to the U.S. government, they would abuse it even more than the Fed. And so we'd have even more inflation than we do now.
I'm going to bring you back to 2008. I mean, let's assume we kind of hit that tipping point, because in 2025 now, I mean, a bank run, as we're talking about, kind of seems digital. I mean, it's Silicon Valley Bank. They had $42 billion that tried to leave in about 8 hours. One institution, because mobile banking and social media amplified the fear. I guess the question is, can the plumbing, the ACH, the Fedwire, handle a rush across so many banks, or does it just simply freeze in this situation?
Well, I think the overall banking situation is worse now than it was back then. All of the too big to fail banks that we should have allowed to fail are now much bigger than they were. And the balance sheets of a lot of these banks are, I think, in a lot of trouble because they own a lot of long-term, low-yielding debt, whether it's Treasury debt, mortgage-backed securities, mortgages, commercial loan, whatever it is. They've got all this debt that they don't mark to market. The accounting says that as long as you claim that you're going to hold your securities to market, you don't have to take a haircut. You can pretend that your capital isn't impaired. And that's fine until there's a run, until depositors need their money. And I mean, that's what you saw happening on a small scale with Signature Bank and Silicon Valley Bank. But that could happen on a bigger scale with Bank of America and Wells Fargo and JP Morgan and Morgan Stanley and all these big banks. There could be a run that would collapse them. And of course, the only way to keep them propped up is for the U.S. government to do it. But then you destroy the currency. You see, the crisis that I believe that we're headed to is not going to be similar to '08. In that '08 was a loss of confidence in mortgages and banks, who were the counterparty to a lot of these trades in the mortgage market. This is not going to be about a loss of confidence in private credit, but public credit. It's going to be about a loss of confidence in the U.S. government. Not necessarily that the U.S. government's going to default, which is certainly not, outside the realm of possibility. I think there is a possibility that there is an outright default on U.S. Treasuries. But I think that what the markets are more concerned about is not that the U.S. government defaults, but that it pays with dollars that have very little value, because the money to cover the principal and the interest is created out of thin air by the Fed. And because there's no real buyers for maturing treasuries, the Fed doesn't become the buyer of last resort. It becomes the buyer of only resort, and we destroy the currency. And so I think this coming crisis is a sovereign debt crisis and a U.S. dollar crisis. And that is also why the price of gold almost touched $3,700 this morning and is headed much higher.
Yeah, it is. And I need to get your outlook on it. Before I do talk about gold, I mean, in that scenario, you're talking about a bank run, or it could happen to a Bank of America, something bigger. I mean, what does the government's panicked response look like? Is it capital controls, withdrawal limits, a banking holiday? I mean, there was the president, right? In 1933, Roosevelt declared a national banking holiday. Greece in 2015, they imposed these withdrawal caps. What do you think?
Well, I think eventually there may be some foreign exchange controls when the dollar really is going into free fall, which I think is going to happen at some point. And I think that the U.S. government may try to stop the bleeding. And that's going to be when U.S. Citizens try to get rid of their dollars. So as you know, the world is getting rid of their dollars. I was watching on television this morning and Scott Bessent was on and he said U.S. Treasury bonds are the best performing sovereign debt year to date. And he's wrong about that because he's not factoring in foreign exchange. The world has seen significant losses on U.S. Treasuries this year due to the 10% decline in the value of the dollar, which has more than wiped out the coupon. And so I think as with foreigners getting rid of their dollars, that's not the concern. But once American citizens come to the same conclusion that they don't want their dollars either, and they want to convert them into some other currency to preserve the purchasing power, and then you really start to see the decline of the dollar accelerating, then the government may try to put a stop to that with exchange controls. That's kind of like price controls, right? The way the government will react, the government creates a lot of inflation, prices go up, and then the government responds by blaming the merchants or the labor unions. And so we have to control prices. We have to control wages. The same thing will happen with the dollar in foreign exchange markets. They'll say, oh, it's the speculators. We have to stop all these foreign currency speculators from wrecking the dollar. It's not going to be the speculators that are wrecking the dollar. It's the government that's wrecking the dollar. It's the Federal Reserve. It's the U.S. Congress, right? The speculators are simply reacting to what they're doing, right? Just like when I raise my prices, if I'm a merchant, I'm raising my prices in response to inflation. I'm not causing inflation by raising my prices. It's the inflation that's causing me to raise my prices. And if people start dumping the dollar, it's because of the fundamentals, the inflation that's being created by the central banks that is forcing them to dump their dollars before their dollar loses any more value. I mean, people don't want to go down with the sinking ship. You want to jump off.
Yeah, well said. Okay, turn to gold for me. I mean, our time always goes so fast because in April we had you on my show here and you told our viewers not to chase physical at the highs, but buy dirt cheap miners. I mean, the miners have, some of them at least, have kind of been ripping. Has the easy money already been made or are we still early in the cycle?
Well, the easiest money has been made. And you're right. When I was on in April, I had just come out with a special report that I was, circulating on the internet. People can get it on my website at Europac.com, the best way to buy gold. And I did that because, gold was over $3,000 an ounce, yet the gold stocks were where they were when it was $2,000 an ounce.
Yeah.
And so in my mind, why go pay $3,000 an ounce for gold when I can buy gold in the ground that's still valued at less than $2,000, in fact, way less than that. I thought that if you looked at what you were paying to buy these gold mining companies, that gold still in the ground had never been so cheap relative to gold above ground. So it wasn't that I didn't think gold was going to keep going up. I just thought, why buy it when they're giving away these gold mining stocks and they're so cheap and the downside I thought was so minimal. It made a lot of sense. And, now I think year to date, gold's up, almost 40%, but gold stocks have more than doubled. So, and so people have made a lot more money, starting in April, because even the first quarter, the gold stocks didn't even move. It started in Q2 and the whole doubling was basically in the last maybe 6 months. Didn't even take a whole year to double. And so, but I don't even think gold stocks have caught up to $3,000 gold yet, let alone $3,700. and we could easily be at 4,000 by the end of the year. So, I'm not telling people to stop buying physical gold and silver now because it's not that obvious, but at that moment in time, to me, these mining stocks were so ridiculously cheap that I couldn't see putting any money into physical gold when you could just buy these miners. I just did not see the downside risk, and I thought there was huge upside potential. Now we've realized some of that upside potential, but I think in the scheme of things, these stocks are still very cheap. If you look at the PEs of the big gold companies, they're very low compared to historic averages, compared to the market multiples. The investors are not in. I mean, they've still had net liquidations all year out of GDX and GDXJ, these gold mining ETFs. Nobody talks about these stocks. Nobody owns these stocks. Yeah. Newmont Mining is the best performing stock in the S&P 500, yet it's probably the stock that's least owned in the S&P 500.
Yeah, and the margins, the margins are incredible here.
Oh, look, they're going to make nothing but money for years to come. They are producing a product that everybody needs, whether they realize it or not. I mean, the central banks are huge committed buyers, right? They're not going to stop buying gold because they're not going to stop divesting of dollars. And they keep earning dollars, right? Because we're hemorrhaging dollars due to our trade deficit. So not only do they have to get rid of the dollars they own, they have to get rid of the dollars that they keep getting. And so they're going to keep buying gold. And as the price of gold rises, it's just going to suck more central banks into it, because the central banks that aren't buying gold are falling behind the ones that are. And gold is becoming increasingly more important as a reserve asset, not just because central banks are buying more of it, but because the price of what they own keeps going up. And that means that the value of their gold as a percentage of total reserves keeps going up. And so, there's going to be a FOMO in central banks to get into gold. And they're just, they're price agnostic. I mean, they're not going to stop buying because the price goes up, because they're just trying to get rid of their dollars before the price goes down. But at some point, the investing public is going to join this party. I mean, I think to an extent, some money is already coming in, and that's why the gold stocks have had the move that they had. But this is just the tip of a huge iceberg that we've seen. And so far, the buyers have been patient, and they've been buying on the pullbacks, and there hasn't been any crazy up days. There's no real euphoria. And I still see sharp corrections like what we're having today. Gold doesn't even go down, right? Yeah. And all of a sudden these stocks are down 3 or 4% just because people are afraid, oh no, this is it. But the minute gold doesn't go down and goes back up, then the buyers come rushing in. The coast is clear. But we're going to get into a stage maybe next year, with gold well north of 4,000, maybe 5,000. Maybe the gold stocks double again from here. But at some point, they're going to get on the radar of the average portfolio manager, and they're going to start buying.
Yeah.
We got a long way to go.
Where is that better risk reward? I mean, is it still with the big established producers, or is it with these junior exploration companies, more speculative?
Well, I mean, there's a lot of smaller companies that aren't as speculative as you think. I mean, if you're talking about a pure exploration type company, because you don't know what they're going to find. Maybe they find nothing. But there are a lot of very small companies that have proven reserves that they just haven't raised the capital to dig up yet, right? They're at the earlier stage. You're not at the exploration stage. Although they may be exploring for more, but they have provable assets, and they just haven't developed them. So they're not, in production. They're not generating any income. And I think there's some incredible value there, because I think these companies are going to get bought up. I mean, it'll be a much friendlier environment to raise capital in the future, and they will be able to raise capital to build out these projects. But I don't think they'll have to, because I think the bigger companies that really have not been investing much in exploration and development, they've just been paying down debt, and now they're buying back stock. I think they're just going to have so much cash that they're generating. They're going to have to do
Use
stuff
it.
with it. And
Yeah,
I
they
think
do.
it's
Use
going to
it.
be cheaper to buy out other companies than spend money on exploration and development. I mean, because you roll the dice on exploration, you don't even know what you're going to find.
True.
Why
Yeah.
do that when you could just buy up these companies and get their whole book of business, right, on the cheap? So I look, there's just going to be so much money made, I think, in the consolidation of this industry, which I think is going to happen before there's any really major increase in exploration and of new projects, which is another reason the price is going to keep going up
Yeah. Yeah.
because there's not going to be. It's not like when gold is $5,000 an ounce, there's suddenly going to be all this extra gold that's being mined. It's not going to be there. Yeah, there may be some more marginal supply. Maybe Americans will start selling off their jewelry at $5,000 gold, to pay the grocery bill, but that's not going to make much of a difference
Yeah.
in the scheme of things. Uh, and so there's not going to be a lot of new production.
Yeah.
And one of the sources of supply used to be central banks selling. Central banks are not selling. Again, they're buying, and they're going to keep buying, especially these emerging market BRIC nations. They still have, very small percentages of total reserves in gold, even though they've been buying. They have a lot more to buy.
Yeah.
It's just that the major central banks, like, in Western Europe, United States, where we still have a lot of gold, but we haven't been buying,
Yeah.
right? The United States hasn't bought any gold.
No.
I mean, we're thinking about buying Bitcoin. That's how dumb we are.
Bitcoin. Oh, we're going to get, well, we should probably get into that. But before we do, let's stick on this. I got to stay on the miners because, I mean, I've been following your tweets. I know when Intel and, the U.S. struck that deal, it was interesting. I don't know if you heard about this new report out of Bloomberg this morning, but the U.S. government is now in talks to launch a $5 billion mining fund with Orion Resource Partners via the DFC to secure, supply chains and to counter China. Are policymakers about to fuel a bubble in this sector we call a safe haven, or what are your thoughts?
Well, look, I don't like any of this stuff. I don't like centralized government planning. I don't like the government's taking an active role in the economy. I don't like the government picking winners and losers and buying into companies. And so the Trump administration is doing a lot of things that under normal circumstances, Republicans would oppose.
Yeah.
I mean, almost everything Trump is doing, if Biden had done it, there'd be universal opposition to the exact same programs. So none of this stuff is going to work. It's all going to backfire. What it does is it leads to a less efficient allocation of capital and resources. It undermines productivity and economic growth, and it leads to higher inflation and a weaker dollar. So all this stuff is bad, And so from that respect, it's going to be good for gold and precious metals because inflation is good for hard assets, especially gold and silver. So when governments screw up, gold does well. I mean, that's why it's almost a can't lose bet because there's no way the government's going to do the right thing. So if you want a sure bet, you bet the government's going to do the wrong thing. And, given the choice between doing the right thing and doing the wrong thing, they'll always choose the wrong thing. So that's why gold's been going up for 25 years. We've just made a series of mistakes that get bigger and bigger and bigger.
Yeah. Do you ever get worried? I mean, this government control you're talking about, in a crisis, a gold or a critical minerals mine isn't just a profitable company now. They're really making it a strategic asset. I mean, we've already seen that aggressive use of national security tools. CFIUS scuttled that U.S. Steel, Nippon. The Defense Production Act has been invoked repeatedly for minerals. In extremis, I mean, why wouldn't a desperate government assert control over domestic mines?
Well, that doesn't work out very well. Look at all the countries that have done that, and they destroy the mining industry the more the government gets involved. The free market will take care of all this stuff, right? You need to have private companies seeking to maximize profits with the full and transparent price mechanism of a free market guiding their decisions. Whenever the government steps in, you circumvent or short circuit free market signals and you don't get an optimal outcome. So, either you believe in capitalism or you don't, right? And clearly the Trump administration doesn't believe in capitalism.
Yeah, we were talking a little bit about M&A there, and I mean the CEO of a major producer, Agnico Eagles, Amar Al-Jundi. We've had him on this show, and he recently warned against irresponsible M&A just because the gold price is so high. I mean, he's kind of praising capital discipline in the industry because they finally learned it, is what he was saying. But now, these companies face a potential flood of this new capital from investors chasing this rally, and then we got these $5 billion initiative from the government. I mean, does this new gold bull market corrupt the miners? I mean, will they abandon discipline and repeat the mistakes of the last cycle? What are your thoughts?
Well, hopefully not. I rode out the last cycle, so I have a lot of wounds from those mistakes.
Yeah.
But hopefully, look, I remember when one of the big mistakes they had in the early rally, 20 years ago, was too many hedge books out there, and so the price of gold was going up, but the miners were hedged because it had been down at $200, $300 for so many years. Everybody assumed that it really couldn't get above 400, and so they had a lot of hedges in place. But look, I think that it's going to make a lot of sense for these companies to invest in acquisitions, because if you're a gold mining company and you have the expertise and you have the resources to build out and develop gold mines, but you don't have, the reserves, it makes sense to go and buy them. And especially if a lot of these smaller companies have properties that are in proximity to the properties that they're already mining, where the cost of developing those projects incrementally would not be that great. So that's what's going to happen. Those kind of acquisitions are going to make sense. I'm not talking about, just paying a premium for another public company that's already high and just, doing a deal. But these smaller companies, it's going to make a lot of sense as long, they do their homework and they go in there and, they kick the tires and see what they've got. But then, make a strategic move to acquire these assets, to develop them for future income opportunities, because they have to replace the reserves that they deplete, right? There's only so much gold they have.
Yeah.
And if they run out of gold, then they're out of business. So they either have to spend money, exploring for gold, or they can buy it if they can get a better deal. And I think there's a lot of better deals out there that are a alternative to exploration.
Yeah. Speaking of better deals, before I let you off here, I mean, we got to talk about silver. Just hit that 14-year high. I know on your X feed, you called it a kind of an express train to 100. I mean, gold's move is often, the central bank buying and its monetary role, as we know. I mean, it's Kitco. But the case for silver seems more complex here. What's the primary driver that takes silver from 42 to 100? Is it monetary demand, or is it a squeeze in the industrial demand?
I mean, it could be both. There isn't a lot of silver out there relative to the demand that I see for it in industry, but silver is just cheap, and it's cheap relative to gold, and that's the best barometer of whether something is cheap or not. Is look at it priced in gold, and you can still get a lot of silver for an ounce of gold, and even at $50 silver and $4,000 gold, that's still 80 to 1.
Yeah.
That's still pretty cheap.
Yeah.
If silver hits 50 when gold's at 4,000. And I think that once silver gets above 50, I think it's going to take off. I think the move from 50 to 100 will be relatively quick. I mean, it'll be a lot quicker than the move from 30 to 50. It may even be quicker than the move from 40 to 50. But I think it's going to unleash a lot of pent-up demand. Why shouldn't silver be double its 2000 or 1980 high? I mean, gold's 1980 high was 850. And we're quadruple that. And silver is still below its 1980 high. And so, there's not that many things that you could find that are cheaper than they were in 1980. Silver's one of them. I think it's very cheap. And other precious metals are cheap too. Look at platinum. I mean, compared to the price of gold. And platinum has already had a big move this year, but it's still pretty cheap. So
Just
I think
starting.
we're finally starting to see some of the other precious metals moving. But silver has always had a stronger monetary correlation with gold. I mean, we sell, a lot of gold and silver at Schiff Gold. We don't sell a lot of platinum. I mean, even though I actually started recommending it when it was under 1,000 and gold was over 3,000, I said, this is ridiculous that you could buy 3 ounces of platinum with a single ounce of gold. But even then, we didn't get that many people that want to buy platinum. But so silver is more what people buy, maybe the poor man's gold. And I think that's also part of what's been going on here is that the central bankers, as the primary drivers, have not been buying silver. They don't want silver. It's too bulky. They want gold. But when the public wakes up to what the central banks are obviously already cognizant of, the public will buy silver. And so when this becomes a retail-driven bull market as opposed to a central bank-driven bull market, then I think silver is going to respond. And while I'm mentioning even Schiff Gold, and I'm sure the same thing at Kitco.
Yeah.
We are not even close to the volume we had in 2020. I mean, 2020 was by far the best year we've had as far as sales and profits as well. There was a rush for a while. People wanted to buy gold and they wanted to buy silver. That has not been the case recently. At
just
all.
Price? Is it just prices? Is it just 3,700, 42? I mean, is it just prices or is it
I think it's a number of things. I mean, the Nasdaq is at new highs, so people are making money on tech stocks, and and they're not worried about buying gold. There was a lot of false optimism, I think, from the election of Trump. I think a lot of gold buyers are Republicans, and when Republicans are optimistic, they don't buy as much gold. It's when they're worried that they buy more gold. Like when there's a radical left-wing president that might rile the feathers of Republicans, and they may start buying more gold and more ammunition and more canned food and stuff like that. But if they're optimistic because they think they got this conservative in Donald Trump, they're not buying, even though Trump's not a conservative. He's pursuing the most reckless fiscal policy I've seen, in modern memory. And we're about to see the most reckless monetary policy as well. So if gold buyers understood this, they'd be buying. But I also think, and I know this from conversations that people at Schiff Gold have had, people are worried about buying the highs. They're worried, I'm going to wait for a pullback. Because I think they've been so conditioned. We had a long period of time from 2011 to 2024 where gold didn't go up. And every time it got near 2000, it came down. And so I think people are a little gun shy about buying these highs, and they're waiting for pullbacks. And I've been telling people not to wait for a pullback because I don't think there'll be any meaningful pullbacks. Not that there won't be any, but they won't be big enough to wait for, and you'll probably miss it because it'll be over so quickly. So I've been saying, look, if you want to buy gold, if you want to buy silver, then you got to buy the highs because that's all we're going to get is highs. And the problem is the longer you wait to buy the higher the high you're going to buy. That's basically the mantra now. So you just buy it. Don't worry about where the price is going to be because it's going to be higher. And if you get lucky and the price goes down, well, then the next time you buy, you'll get a better deal.
Yeah, especially with the central banks on auto buy. Okay, before I let you go, I mean, you've been early on this thesis, right? You've been years ahead. You've been criticized for it, but it is starting to play out. I'm curious, I mean, when future historians look back on this period, what are they going to write, Peter? I mean, will they see it as a moment America chose a path of managed decline through inflation, or is it going to be as painful but this necessary crisis that kind of forces to return to sound money?
Well, that book isn't written yet, so I don't know. Because we don't know if this is going to be a catalyst for a positive change or if it's going to be the opposite. Are we going to go all in on socialism and completely destroy what's left of capitalism and have hyperinflation and a totalitarian society for, look, look how long Argentina had to sweat it out before they finally elected Milei. And, we could be in for an even darker economic period than they lived through. So I don't know. I can still be hopeful that we'll learn our lesson and we'll do the right thing, but there's no sign of that now. I mean, now we're doing everything wrong that we could possibly be doing wrong. Yeah. But we haven't really been forced to do anything right because we've been able to kick the can down the road. We've been able to keep running these deficits, the budget deficits and the trade deficits, to the point where, Donald Trump actually thinks that the world depends on us, that we got him, just where we want him because we consume so much and we borrow so much that we're so important. Well, he's going to be in for a rude awakening when he finds out that it's the other way around, that the world needs us like a hole in the head, that the world is perfectly capable of consuming what they produce. And they're perfectly capable of investing their savings in their own economies. They don't have to loan their money to us. The problem is Americans can't produce what we need, and we don't save what we borrow. So we're the nation that depends on the rest of the world. Mm-hmm. The rest of the world does not depend on us. And so when we realize that and we get a monetary crisis and a debt crisis, then we'll see. Yeah. But as you mentioned, I do think one of the more interesting anecdotes, whenever they write this history book that includes this period, probably one of the most amusing parts will be Bitcoin and the crypto craze, because that's going to be the new tulip mania. So they're not going to have to go back to the Dutch, in whatever it was, the 1500s, wherever it was, to find a great example of mass delusion and the madness of crowds when it comes to a bubble. They'll have Bitcoin. They'll have Bitcoin. So that'll be a case study for a long, long time.
Still not a fan, Peter? All right, man. Listen, we've come up on about 50 minutes. I appreciate it, of course. Quite interesting here. Sobering perspective as always. Peter Schiff, thanks for this. Thanks for joining us.
My pleasure.
I appreciate it. All right, a great repricing is underway. And the question isn't whether it's happening, it's how it ends. Don't forget to hit subscribe right here on Kitco News. I'm Jeremy Szafron. See you next time.